Welcome back. Thank you so much to my colleague Nompumelelo Siziba there for holding the fort here on point. We're now here at the Johannesburg Stock Exchange. My name is Arabile Kumete and here to take you through until 3 p.m. We kick things off then by taking a look at how the market picture has sort of looked across today, starting of course with things out in Asia. We waited for that GDP print out of China. Then 4.9% was the number, the third quarter that is. 4.9% between July and September. That was the growth figure. Yes, the estimate of some economists from a Reuters poll was for 5.2% growth, so the number perhaps not necessarily surpassing expectations in any way, but it's still an uptick considering that the second quarter was also up 3.2 odd percent. And now for the 9 months of the year, we've seen GDP go up 0.7% in China as well then. So still a positive tilt, the world looking towards China to perhaps help them, help in creating demand, that is, not just for stocks, but certainly for produce and other items as well. And of course, it is a major oil importer too. So the picture across most of Asia was a mixed one, with even the Shanghai Composite going down despite that figure of that 4.9% uptick. But as I said, not higher than expectations, in fact lower than it. So it does mean that the market didn't necessarily take too kindly, perhaps a slowing down of that economy as well. We're talking about economy here as well that used to grow beyond double-digit growth at some stage, and 6% was considered the lowest in quite some time. And of course, that first quarter getting absolutely hammered. All right, then more than 1% gain then for the Nikkei, 1.1% up. The Hang Seng as well, 0.2% to the good. Pretty much a mixed picture as well out in Europe there, with the DAX pretty much flat on that front, though the FTSE 100 has dropped down more than 0.1%, 1/3% weak as the CAC 40 out in France. Onto the local market then, up but only just 0.2% to the good then is the JSE All Share at this point in time. A lot of that has been led by the banking counters, which means that the financials have gone up 2.33%. So a good day across the board on that front there. And also coming through from the strength in South Africa's currency thus far. The industrials have gone down nearly 0.5% on that front, with resources going down, having seen a bit of a mixed picture then with the gold miners and the platinum shares. Talking about shares that have gone up today, Afrox, African Oxygen, going up 36.8% to sit at 23.95 rand a share. We'll talk about the significance of that in just a moment or two, because that one is set to perhaps leave the JSE very soon. Of course, it is owned by American-German company Linde, which is set to take up more shares that it actually just doesn't own in Afrox. It currently has a 50.47% shareholding in African Oxygen right now. So it's going to take up the remainder of that and delist it from the Johannesburg Stock Exchange. The likes of Into Properties have certainly delisted from the JSE this year. SAW has also knocked itself off. Tiso Black Star Holdings have also come off the JSE this year. So all of those coming off, and 21 other companies just last year. So seems that the trend does continue. We'll unpack that in just a moment or two. So that's the big gainers across today, with SAPI even going up more than 17%. Telkom has been a big loser today, more than 4% down today, with Sign-Off as well going down 3.2%. Onto the commodities board then, Brent crude is just marginally lower at this point in time, sitting just below $43 a barrel there. Platinum has gone up, some demand coming through, $873 a fine ounce on that front, with the price of gold sitting at $1,912 a fine ounce. It's 0.7% better off. Onto the currency, a 0.6% better off there, still sitting at 16.44 rand against the US dollar. So a little bit of strength coming through, considering that the Chinese economy has grown somewhat. But whether that necessarily means the continued strength for the remainder of the year is yet to be seen. Of course, a sustained picture is what we're looking for. Just over 0.1% better off is the local currency against the euro there. So we're at 19.36 rand, pretty much flat against the British pound, 21.38 rand against the British pound there. All right, then let's bring Gary Boyson into the discussion then. He's from Rand Swiss, and he joins us here at the Johannesburg Stock Exchange as we unpack this market picture a little bit more. Gary, thank you so much for the time. A bit of a mixed one all across the board. China's GDP figure coming in much anticipated, but 4.9% still a bit muted according to the market.
Yeah, I think economists are a little bit disappointed. They're expecting a stronger rebound, just with, I think, the positive news that we've got around the Chinese economy picking up and some of the other data points. So if you look at, let's say the retail sales figures, you look at consumption in China, it's been pretty strong. The export numbers have also been decent. So I think everyone's just looking for a little bit more in terms of GDP. But also, if you look at the factory output in China, it looks robust. It looks like this economy is recovering, but it all remains to be seen. It's such an export-led economy that if we do see coronavirus cases rising as we're seeing in Europe, if we see more aggressive lockdowns coming across the developed markets, that means their customers are essentially not going to buy, and that could just hamper them a little bit. That said, I mean, you mentioned that 6% is kind of it's kind of the mental number I think we most have around where China should be growing. But remember, China is a much bigger economy than it used to be, and that's it's difficult to continue to grow at 6% when your pie is that much bigger.
And look, we still call them an emerging market. It's kind of difficult to really do so. As you said, their economy just so much bigger at this point in time. Are we expecting a little too much out of China now, considering, as you said, their pie is so much bigger? They've gone into almost every avenue they certainly can at this point in time. Everything from tech to agriculture is certainly a big part of their economy. Are we expecting just a little too much out of them?
I don't think so. So if you look at China, it's incredibly interesting because it's such a yes, it's made moves towards a market-driven economy, but it's essentially still centrally planned in a way as well. And with the the kind of advent of these social media tools and all the digitalization around information flow, it's a really interesting experiment to see whether that level of control, what it does to economies and what it does to, I suppose, GDP per capita, what does that do to the quality of people's lives as well. So I think that China is going to be a fascinating thing to watch over, let's say, the next 10 years. But is there more to come? I mean, it's difficult to say. What we do know is that if you look at, let's say, oil markets, for example, because of the nature of the Chinese economy, they could be stocking up on oil when other economies were essentially closing down their production was there. China could take advantage of that, full of strategic petroleum reserves. We had stories of literally tankers lining up outside Chinese ports and not actually be able to get the oil off into the refineries because they were just buying that much. I mean, they've been doing more than, I think it's 11 million barrels per day for the last 5 months throughout lockdown, because they could, throughout at least the coronavirus crisis, because they can look at it and kind of make that logical decision. They're not as bound by market dynamics as developed world. So I think China is interesting. I mean, where China is going in the next 10 years, I think it's an exciting question. I mean, I don't think anyone can answer it with any degree of certainty.
They've been fascinating to watch over the last 10 years. Now, another 10 years of more interesting stuff certainly coming through. We'll see how things fare there. But if we talk locally then, and we talk JSE, yes, we've gone up today 0.2%, but big news, I suppose, lately has been African Oxygen set to delist from the Johannesburg Stock Exchange, but they join a whole horde of people that have decided maybe listing is not necessarily for us. Is there a particular reason for that?
Well, there's many reasons, and I don't think we can cover it in such a short segment. So it's, one, I think it's important to understand this isn't a JSE only problem. This is an international trend. You're seeing there's a consolidation of companies across the world. The number of listings in New York, in Europe, all over the place is much smaller than it was in 2000. So yes, we've lost, I think, 250 companies since 2000. But that's not necessarily just the South African issue. And I think one of the key drivers is it's the ability to operate in the unlisted space makes it a lot easier. So if you look at the Afrox's delisting, for example, I mean, obviously Linda's already a majority shareholder in the company, but they want to integrate it more into this much larger entity. And it's essentially the only asset that's a listed asset that Linda still owns. So they want to obviously naturally delist it and bring it into the overall group. And I think the management of these mega groups is becoming easier and easier. I think in a part that's technology playing a role. You don't need that kind of dynamic pricing coming off an exchange in this multinational group. And we can see the size of companies. I mean, if you think about the likes of Apple and Amazon and even something like Alibaba, Google, these are trillion, well over $1 trillion market cap companies. And And yet they manage to efficiently allocate resources without the need for a listing. I think the other thing that has to be mentioned is also just the rise of passive products. So if you look at what's happening in the passive space, everyone understands, let's go buy ETFs. We can just, we can kind of capture market growth without needing to, essentially do underlying analysis on companies. We don't have to go and buy AFROX necessarily. We'll just go and buy a general JSE tracker. Now, the impact of that is you have less people looking at it. You have less liquidity in the stock. So another reason that AFROX is delisting, and one of the reasons that I think it's going to be a successful delisting, is that this is providing a key liquidity event to investors. Investors are looking at a very liquid share price. There isn't great price discovery in AFROX because not a lot of people are trading AFROX shares. And now suddenly Linda comes along and says, we'll get you out at, if you take out the dividend, it's over 50% premium to the current share price. Everyone's going to jump at that because they're going to say, well, at the moment, if I'm a big shareholder in AFROX, I might not be able to find a buyer because markets aren't functioning the way they used to. As I said, I blame, in a way, passive products for this because the investors that used to go into direct stock ownership are now going into these basket products. What that's doing is it's also reducing the quality of research around companies, and when research quality falls, again, you don't get the same price discovery, and you also don't get the same liquidity. You don't get as many people making decisions and buying and selling.
How do these companies though then make money in future? And you list on the JSE for many reasons, but one of them primarily being you're able to raise the capital, you're able to raise funding and whatnot from being listed. How do you do that now?
I think that's also a very, very important point. So it's again the nature of capital markets, I suppose. The private equity space has become so much more developed, and it's easier and easier to raise capital via private equity firms. And private equity firms will go out there, they'll look at the investment case of the thing, and they will fund projects. Capital has become very, very cheap. Well, another reason could be lower interest rates. So when you see interest rates and just how cheap the price of money, which is essentially what an interest rate is at the moment, you can go out and private equity firm can quite easily raise the debt. They have their own internal shareholders, and they can go and essentially fund these companies without having to go through a formal exchange. The benefit of having it outside of the public eye as well is that you don't have either. South Africa, we still have kind of a semi-annual reporting schedule, but in overseas, they're reporting quarterly. There's this focus on trying to beat those quarterly numbers, and quite often it's not in the best interest of the company to do that. There might be a longer term strategy where you have to go through 3 or 4 quarters of pain before you're going to see the benefits of that. That also makes often companies in the private space more attractive and almost better managed. So we've seen, if you think of Edcon as a good example as well, when it gets into trouble, they delist it, fix it up in private, and then relist.
Same thing for Alexander Forbes in some instances as well, actually. Just very finally then, I suppose, is just you have the situation continuing to happen, but then investors have less and less choice still though on the JSE. So what does that actually mean for a market like the Johannesburg Stock Exchange?
It's very sad. So if you look at our market as well. So one more point as to why I think we're seeing the low liquidity. We've also got more exchanges popping up as well, which everyone says, oh, that's great, more competition. This is going to be good for pricing. It's going to be good for that. It also, when you're looking at a centralized exchange like this, if you have multiple exchanges, suddenly you don't have there's almost, in a way, you don't have the liquidity because you need the liquidity. You need that central marketplace for everyone to come and buy and sell. But what does this mean for the JSE? What does it mean for private investors? It means very little for the wealthy investors. It means very little for people that have access to private equity funds, to more sophisticated products. The people that are really going to get punished are the retail investors. It's the man in the street that now can't go and be part of, let's say, I know MTN and Vodacom still listed, but you want to be able to, the products and services you're using on a daily basis, you want to be able to invest your money directly in those company stories. You want to kind of almost back your team. You're not going to be able to do that if it's in the private equity space. It's going to be more sophisticated products. And until we see, I suppose, technology coming to the fore where you almost have these alternative exchanges that give retail investors access into the private equity space, unfortunately, it's the real exciting assets are going to be the domicile of private equity funds.
Sure. That discussion gets more and more interesting. Gary, appreciate it. Thank you so much for the time. Gary Boyson from Rand Swiss, they're joining us as we get to grips with that one just a little bit. A lot more companies out of the JSE seeming to delist and perhaps go into a more private space. As Gary said, perhaps finding it easier to manage themselves in a different space as well. So it'll get interesting from here. How exactly investors get involved in it all is going to be quite critical. We're going to